Does it feel like your dollar is purchasing less and less by the day? Is the economic data even making sense? And is the steady erosion of your purchasing power putting your retirement at risk? More importantly, what can we do about it? How can investments in safe haven assets like physical gold and digital decentralized technologies like Bitcoin be used to counterbalance this constant erosion of our purchasing power? If you think that you may be falling short of your retirement goals, see the link in the video description to the free inflation and retirement calculator. To discuss why gold works, why fiat currencies ultimately fail, and why gold and other scarce assets act as an insurance policy against risk, we will hear from macro analyst and investor Lyn Alden, economist, White House advisor, and author Jim Rickards, economist and investor Keith Weiner, and author and economist at George Mason University, Lawrence H. White.
100 years ago, it was different. The term inflation was used to describe what today we call monetary expansion. That is, an increase in the supply of money rather than the result, which is the rising price level. The great virtue of the gold standard was one, that it was apolitical, right? The quantity of money did not depend on a committee meeting and deciding based on their reading of the economic numbers what it should be. And it responded in a way that stabilized its purchasing power. It's nice to have 30-year bonds, 50-year bonds, even 100-year bonds were issued under the gold standard. Nobody issues them under a fiat standard. There's just too much unpredictability.
One of the ways that they could combat inflation is to repeg the dollar to something. We have been in an unusual period in history for the past 50 years. Now a lot of people have come to think of, money not being backed by anything as normal. Whereas if you look back over the really long stretch of human history, this was an unusual 50-year period of, the entire world. Every fiat currency in the world is exactly that, fiat. So it's not backed by anything officially. And so that's been an exception rather than the rule to human history. So I do think people should have an open mind about what currency looks like 10, 20 years from now. I think there's going to be a lot of ways that could play out. But I think in this decade, in order for that to happen, you'd have to see a pretty big inflationary crisis. The policy intervention is kind of relentlessly inflationary. So I do think that we're going to see higher inflation in the 2020s. I do think we're going to see long-term negative real yields, and I do think there's going to be a shift out of some of those paper assets into some of those scarce assets. And ultimately, where that settles, I think, is an open question. But I think the first step is to make sure you have exposure to some of those scarce assets, things that have kind of intrinsic value, whether they're real estate, whether it's key commodities like copper or uranium or nickel or silver, things like that. Gold for some investors, maybe high quality equities, things like that basically is a claim on something of intrinsic value.
I think a gold standard with free banking, I think there's evidence, would be better than the status quo. It would give us more stability of purchasing power. It would give us a sounder banking system. We wouldn't need too big to fail. We wouldn't need the moral hazard that comes with that. And it would give us sounder finance if we didn't have a central bank to issue things like the Greenspan put, which sort of opened the door to moral hazard. How can we get there? Not by hyperinflation, which is how some countries have lost their fiat monies. Nobody hopes for that.
Reach in your wallet or your purse and pull out a dollar bill and hold it up with two hands and look at it. Does it have yield? No. But when you have money, at least a sound form of money, you don't have any risk. And so the idea that gold has no yield, well, that's literally true, but it's not supposed to have a yield because it's money. Now, you say, well, I can get yield on my dollars by putting them in the bank. That's true. And people think of it as money, but that's not money anymore. When you put your dollar in a bank, it's not money. It's a bank deposit, which is an unsecured liability of banks that as recently as 2008 and even later were completely insolvent. Now, yes, they were bailed out by the federal government. There's FDIC insurance, and I understand that. But even if you're under the insured limit, how do you know the insurance deposit insurance corporation itself is solvent? That's not always true. How do you know that bank withdrawals won't be suspended or reduced as they were in Greece and Cyprus? And then people say, well, that would never happen in the United States. And I point out it did happen in the United States. In 1933, there was an 8-day bank holiday. Banks were, by executive order of the President of the United States, banks were shut. The government did not say when they would reopen. It turned out they reopened 8 days later, but for 8 days you couldn't go down to the bank and get your money.
Gold seizure by the government. In 1933, Roosevelt had two reasons for taking the gold, and they both had to do with he wanted to manipulate the money, because at that time, obviously, gold was the root of the monetary system. He wanted to stop the run on the banks when people withdrawing their gold coin was a run, which today it wouldn't be. And secondly, every time somebody withdrew a gold coin, it forced the bank to sell a bond, which would push the bond price down, which is the same as pushing the interest rate up, and Roosevelt wanted to push it down. So the government today doesn't have the motives that Roosevelt had in 1933. I don't think they're likely to care about it if If anything, they'd be cheering on if the price of gold is going up, every buying and selling, generating capital gains taxes. I think they'd be laughing and collecting the taxes on it. The state of Texas passed, I forget what their act was called, but created a gold depository. The depository itself is not all that interesting. There's a lot of depositories around the country, but the law contains a provision that the state of Texas would be obliged to stand up if there were to be a confiscation from the federal government. The state of Texas would somehow be obliged to stand and defend your gold. I have no idea how that would work out. That sounds like a constitutional crisis, if not an armed, standoff. I don't have any clue as to how that would work, but that's kind of an interesting feature of that. Other than that, there's your usual suspects, your Brinkses and your Loomises that have vaults around the country, particularly Delaware. There's several, and I would generally recommend, because of the risk of certainly fire, flood, but also home invasion, you shouldn't really have the majority of your wealth at home. It should be in a professional depository, not a bank depository, but a private depository.
People say, I've got money in money market funds. Another misnomer or oxymoron, because the SEC recently issued a rule saying that money market funds can suspend redemption. So everyday Americans think that they can, call up their broker, sell their money market fund units. The money will be wired to their account and it will be available to them the next day. Well, that's a nice, warm, cozy assumption, but none of those assumptions are necessarily true. First of all, money market funds were in the process of becoming illiquid in 2008, and the government stepped in to bail them out. Today, they're allowed to suspend redemptions just like a hedge fund, so they don't have to give you your money. And again, people say none of these things will happen, and I just point out they have all happened. So I don't recommend taking all your money out of the bank or selling all your stocks or cashing in everything and buying 100% gold. What I recommend is about 10% gold, 10% of your investable assets. Take about 10%, get gold. That's your insurance policies.
Gold is clearly on the rise and making historic highs. The 5,000-year history, gold is the one asset that has outlasted numerous business cycles, economic downturns, booms and busts, stock market bubbles, and the rise and fall of every currency. And unlike depreciating, faith-based fiat currency, gold is no one's liability. Gold IRAs provide a tax-deferred means of building wealth, storing it securely, as well as protecting your retirement and purchasing power from counterparty risk. If you are ready to start your gold investing journey, see the links in the video description to the best gold IRA companies that we have personally reviewed and vetted. To attend a free gold education webinar held by Augusta Precious Metals, see the link in the video description. Thanks for watching.